invest in a market that you do not live in. But before we get started, if you want to hear monthly and weekly updates talking everything about multifamily, make sure you go down there and hit that follow button, because each and every week we do a weekly webinar talking about all facets of multifamily investing. So again, I'm Jason Yerzy of Yerzy Holdings. We are a multifamily investment firm here in Middle Tennessee, investing in majority multifamily assets here in the Southeast. Today we're going to talk about how to invest in a market that you do not live in. Now, I will preface this that if you can invest within your market, that is always the best starting point. It's the market you're most intimate in, the market that you have the most knowledge over, and the market that you've built the most relationships in. However, at points, that market may not be the best one to meet your investing philosophy or just be the most dynamic market for where you want to go with your business and your investment business overall. Myself, I was in New Jersey. When I first looked at buying multifamily, New Jersey had a number of things that just were not hitting the price point, right? So the price per pound in New Jersey is very high, right? So you're paying more for a unit compared to the rent you can get. The taxes are high, the insurances are high, the utilities, usually because there's older buildings and the roadways, everything's outdated. Landlord versus, of course, tenant laws are not in the favor of the landlord. There are a number of things that ideally just were not perfect. So I started looking at other markets that could be beneficial to meet our desired investing philosophy. And I came upon Louisville, Kentucky. Now, with Louisville, Kentucky, I started to dive into the submarkets. And this is usually where investors get sidelined, is that they start trying to invest everywhere, right? Because when you are looking at markets, everything seems greener than where you are, right? So it's always the assumption that over the hill is going to be that much better than where you currently are today. Now, that's not true. Even if you're investing in your own city, and you're not investing all over that city. Just think about it. Like, where do you invest, right? There's going to be some neighborhoods that you don't want to go into, whether it be crime or just poor aspects or just not having the future path of progress, right? There'll be other areas that may be outpriced, right? It might not be the markets. They've already had the growth, right? So you're going to stay in the zone. And there might be other areas where not good school zones or over on the other side of the tracks, as they say it. You're investing in certain areas of your market. So when you go into other markets, it's going to be logically that you're going to do the same thing. So when I was looking and focused on Louisville, Kentucky, I was not investing in the East. It was too expensive. I was not investing downtown. It didn't have the parameters we were looking for in terms of garden style buildings. I was not investing in the West because it just had pockets, just had a lot of crime, a lot of things that we just did not want to be around. We felt the path of progress was going away from that area. The Southwest, just in terms of the nature, there was just a lot of poor pockets, and the growth there, again, wasn't fitting the need. We invested in the South and the Southeast. We felt this was the most blue-collar workforce housing area. It also had a very strong occupancy rate, did not have a lot of new construction coming online, and had a plethora of course, garden-style buildings. So as we do that, and I will stop saying of course, we started to dive in and say, okay, what kind of buildings are we going to focus on? We started to get very honed in on we want to find 75 to 100 unit apartment complexes. Now we set the threshold, the floor at 75 units because we wanted a building that we really could get the max out of property management by having a full-time leasing and maintenance people that could be afforded by the property. Then focusing on this area here, we said, okay, what kind of buildings usually exist here? Well, a lot of the product was built late 60s, 1970s. So we were really focused on the 1965 to 2000 build in the Southeast and South Central submarkets of Louisville. Okay, what are the price points, right? We started to say, okay, the price points here at the time we want to get into these buildings, we were probably going to spend anywhere between 3 and 7 million. So we started framing the cost of what we wanted to look for here. Then we started looking at the areas in terms of street by street, right? Where are the schools, right? Where do people want to live? Where are the neighborhoods? Where are the clusters of pockets? What is also the surrounding areas, right? So what is around there, right? Is there the good grocery stores? Is there access to roadways? What are the school systems like there? What else surrounds the areas that we're going to focus in? You don't want to be into a food desert. You don't want to be in areas where there's not at least reasonable schools. You don't want to be in areas where they don't have access to get to the roadways. We don't want to be in areas that may be surrounded by some unlikely or just unpleasurable, we'll say, businesses, right? So we wanted to find those areas and those pockets. And so we got really highly focused. And what I found is doing this, I started to dial in to understand this market better than people that I knew that lived in that market because I was putting the focus. And most of the time, many times when someone lives there and they're just doing their every day, they're not going to these areas that we're investing in because they're just going to the hot spots, right? They're going to the new Top Golf, they're going to the new areas, right? They're going to the new bars and restaurants. And most of the time, that may be in different neighborhoods than we are trying to find investment properties. So as you focus looking in an area here, say, when we do find that area, how can we get there? Now, on the front end, what were some of the pieces of the puzzle we looked at when determining what market we wanted to go into? Well, we wanted to have some population growth. Even if it's 2-3%, we wanted to see upward trending growth. We wanted to have job growth, right? People are coming there because jobs are being offered. And of those jobs, we wanted a diversity of jobs. So we didn't want one employment sector making up more than 20% of the industry because if something happened with that sector, well, it could really take a dive if it's 75 or 100% of the market. We wanted to have the development not be over empowering the move-ins to the market, right? We didn't want so much supply coming on that was constantly going to push on the vacancy or the occupancy of the market in the area. We wanted a landlord-friendly market, right? There's actually, we have a whole list of these. We have about 20 to 25 markers that we check on here when we're going into a market, right? We wanted to have schools and school systems that had some desire. We wanted to have low crime, right? There's going to be crime everywhere, but low crime, right, in the areas we're investing in. So as we're looking at these markets, these are some of the pieces that we are putting together to determine not only that we want to invest in Louisville, but the area of Louisville that we want to go to. So as you go through your journey, hopefully this will help you get out of the gate and say, okay, my market's not working for me. How can I look at other markets and how to really get honed in on where to invest in that market? So if you like what you hear, make sure you go down there and hit that follow button. We will be back each and every Thursday, as we always are, talking about multifamily investing. I am Jason Yarusi of Yarusi Holdings.